Good evening, everyone. March is a month that's absolutely packed to the rafters with full year earnings results. For those of us who are in this space and those of us in the business space, love to pay attention to the results coming out of the banking sector, because more often than not, what happens with our banks is mediators of capital, right? You mobilize deposits on one end and you deploy those deposits into the market on the other. They tend to tell us a very interesting story about where our economies are going, the health of businesses, the health of households, the health of the economies, right, in which we operate in. We'll be focusing on one of those banks today, I&M. Now, there's a lovely bit of symmetry, in fact, in having I&M management back on Mango Spaces, actually, since as Eric reminded us a little earlier on today when we were talking about this space, I believe the very first space conversation that the Mango Capital account actually hosted all the way back on the 16th of June, 2021, was with I&M. So there's a lovely bit of symmetry in having them back on the space at the moment. And since then, fun fact, the bank share price has actually gone up by 51%. It's roughly 19% higher than its pre-pandemic levels back in 2020 as well. Over the course of the hour, we'll have a conversation with the regional CEO, Akihara Maina, as well as the Group Chief Financial Officer, David Gatho. We'll be going over the 2024 results and looking ahead to the operating environments in 2025. Without any further ado, Akihara, I want to bring you into the conversation. For those of us who may not have seen the numbers and your results presentation earlier today, give us the 1-minute summary of what the performance was like in 2024.
Thank you, Rama, and it's great to be back on X Spaces. I think the last time we were on this, it had a different name.
It was called Twitter back then and had a different owner.
It's great to be back and to talk about our results for 2024. Quick summary, 25% performance on a profit before tax basis. And this is accompanied, of course, with a final dividend that we're declaring of 1 shilling and 70 cents to complement the interim dividend we gave of 1 shilling and 30 cents. So that's coming to a total of 3 shillings. And as you indicated, this is also reflected in the share price that we have seen. Our counter has probably been one of the best performing in the stock market. But all round, strong performance for the group. We've had strong performance from the subsidiaries outside Kenya, contributing 29% to group PBT, and also a very strong set of results reflecting a 17% growth in PBT. Balance sheet, while this has been flat, it reflected some of the challenges that we've seen with currencies around the region. But if you look at the individual subsidiary performance, that has also been strong on a local currency basis. In terms of provisioning, that was 14% up. I think we all appreciate the difficult times our different economies have gone through. But that, if you look at absolute NPLs, that's relatively flat at about 35 billion. And what this translates to then is a relatively flat cost of risk across the group at about 2.6%. Let me stop there and then we can dig into the details a bit more.
I do want to start with the loan book, right? Because there were some interesting trends there. We saw this contraction of around 8% in the corporate segment, 7% in the retail and the business banking segment. What's your assessment of where client demand for debt is at the moment, especially going into fiscal 2025? Is it likely to remain in that same trajectory, or might it remain flat this year? And if so, why?
So speaking for Kenya in particular, I think we have seen the impact that the macros truly have on the customer balance sheets and appetite for credit. I think look back to 2023, we were starting to see interest rates rise. And as we battled inflation, you will recall inflation had even touched just under 10% or so. And the aggressive action that had been taken by the central bank on the monetary policy front to rein in inflation meant that interest rates went up to just under 17%. Now, last year, that trend started reversing. But as you will have heard in conversation on the stickiness of interest rates as rates are coming down, it has meant that customers have seen for the last 2 years or so a rather high interest rate environment, which has then been reflected in some prudent steps that they must take. It's a bit difficult to get returns above the almost 20% rate of interest that we were seeing in the market. And that meant that in some cases, customers were deferring any capital expenditure. They were focusing on simply just managing their working capital. So it's not surprising that we saw credit to the private sector actually dip in the previous year. Now, with the interest rates having come down in late 2024 and also early 2025, the expectation is that you will see growing demand come in, with customers revisiting some of those plans for capital expansion, just simply because it's a bit more affordable now. We're not out of the woods yet, and some of those adjustments are yet to happen, but this is what we are expecting.
Looking at it from the supply side, right, there's been all these policy moves to try and make a bit more liquidity available in the market, right? The central bank has cut the policy rate, banks obviously reducing the retail rate as well. There was a cut, 100 basis points to the cash reserve ratio, which frees up a fair bit of liquidity to come into the market. But looking at it from the perspective of households and consumers, so if you track where real wages have been over the last 5 years, Kenyan households effectively have been facing a decline in purchasing power, right? Every single year from 2020 through to 2023, and likely the same in 2024. That trend, right, of a very constrained pot of disposable income is likely to remain in place for 2025. So even if there is a reduction in the cost of credit, how will that then translate, right, into demand for future credit? Because to put it crudely, households and businesses will probably be like, hey, we just don't have the money.
Absolutely. It's quite spot on. And I think therein lies a bit of a paradox, right? Because yes, your disposable income is being raided. And as a result, people are then looking at adjusting how they spend their money. What that means is if you want to stretch the reduced disposable income that you have, you're then looking at the role that credit plays in that. So you're saying, can I borrow to meet some of these needs? So we expect that at the household level, you will see greater use of credit. The fact that interest rates have come down actually then means you can perhaps borrow more because rates have come down and your monthly expenditure on loan repayments will be that much lower. I think it is still something that we have yet to validate. We did see in 2024 that there was seriously strong appetite on the retail side. Personal lending initiatives have grown quite well. And particularly because you're offering it on digital channels, we in particular developed some interesting personal loan products that are easily accessible via digital channels. And we have seen the appetite for that grow. Not so sure when we'll truly see that signal, but I think from the macro level, if you consider the decline in disposable income, the need for credit will certainly rise.
One of the other things that I've noticed, just looking at the results coming through, at least in the course of this month, is clients are moving towards a lot more short-term facilities, like the digital loans that you've spoken about, for example. And just looking at that specific market segment, lots of banks, even non-bank institutions, SACCOs are now even in that space, offering some kind of short-term loan facility through digital channels. In a market that, at least on paper, looks increasingly crowded, what's I&M's differentiator? How do you make that product sufficiently sticky to keep clients coming back?
From our experience, and we have been engaging in the retail lending space on the longer term and progressively introducing even shorter dated solutions for clients, we have seen actually an increasing number of customers actually joining our platforms because they want to be able to access credit. So to give you an indication, we have had just about 50,000 clients who've joined over the past year, and 50% of those have actually come in through digital channels. Now, they may be building up their profile, obviously, from a lending perspective. We will then assess them, give them a pre-scored limit, which we make it very easy, really, for them to make a decision on whether they want to borrow. So we'll tell you, Rama, you qualify for 30,000 shillings for 30 days, right? And you just need to click to be able to access that. That's immediately dispensed into your current account. Now, you can choose to repay it over 8 days. Maybe you're looking to fulfill something very quickly. And once that is repaid, you can take that second facility immediately after that. Now, customers have responded very well to this. And we are seeing, of course, the numbers growing in that space. What that does is, of course, that you're turning credit a lot more frequent. You're churning it a lot more frequent. The longer dated borrowing still remains. You'll still have people who have need to finance assets, whether it is mortgages that they're taking or vehicle finance and so on. But I think that's where the reconsideration is actually happening to our earlier discussion. Do I really need to buy that car now? Do I really need to buy that house now? But from a short-term funding, managing your borrowing needs for the short term, that I think has been rising. David, I don't know whether you'd want to comment on the question.
Yes, the one differentiator for us, and thank you, Kihara, is the fact that our mobile solution is free You can access it without any charges. And we have seen that being a competitive advantage for us, where customers do want to manage their financial affairs using our channels, because then they do know that they can transfer monies in and out without incurring any cost. As you've observed, as the disposable income have become squeezed, then the customers have become a lot more sensitive to some of these charges. So we are seeing that driving uptake in our digital channel.
Just before I get into the question around NPLs and the broader discussion around that, can you give us any sense of what the churn rate is like? If a client comes in and says access to the app is relatively free, it's pretty straightforward, but do these clients come in and stay for the long haul? Or are we seeing the sort of same behavior that we've seen, for example, on the non-deposit taking side of things, where you've got clients who are active on multiple platforms and they're not necessarily quote unquote loyal, although that's a bit of a crude word to use here, loyal quote unquote to a specific platform. So they're simply shopping around for the best possible deal.
I'd say that you're actually seeing stickiness, and it's also driven by the other complementary aspects of our offering. So as we were the first, perhaps still the only bank to offer free bank to mobile money transfers and vice versa. And that has really helped. We were talking earlier about the disposable income that squeeze that we are seeing. It makes sense for individuals and for particularly sole proprietorship businesses to take advantage of the reduced fee profile that the bank offers. So that is leading to attraction, and it is leading to stickiness. So in terms of customer churn, that has actually been very limited. We are seeing over 70% of the accounts that are opened on the app actually being funded within less than 2 weeks or so. So that is not a concern. And we are also seeing, of course, that when customers borrow, they are interested in getting that opportunity to borrow afresh, because your credit profile improves as you pay.
David, I want to bring you in. Let's talk about NPLs, right? Because the number that we saw in the results you presented, 35.5 billion shillings, as far as the gross number is concerned, which went up marginally compared to some of your peers in the industry. We've seen double-digit increases elsewhere. Gross NPL ratio is 12.4%. That's about 400 basis points below the industry average. Can you give us a bit more color on what the NPL side of the portfolio looks like? Where is it concentrated? What's driving its accumulation?
Yeah, overall, our loan portfolio is about 70% corporate and institutional, and 30% retail, premium banking, and business banking. And our NPL shapes are the same way. So 70% of our NPL is in the corporate and institutional segment of our customers. And then the 30% is the other three segments. Then regional-wise, Kenya is the biggest subsidiary. So Kenya accounts for 30 billion of that, 35. And then what we have seen, and we've just spoken to the challenging Kenya macro. So we did see the Kenya on an absolute number, the Kenyan NPL rising from about 28 to 30 billion. But for the rest of the subsidiaries, particularly in Tanzania and Uganda, we did see significant reduction in the NPL absolute number and ratios for those two subsidiaries. Tanzania declining from 21% to 8%, and Uganda from about 14% to 5%. In Rwanda, slight uptick, 3% to 5%. But the biggest chunk of the increase we saw, and which corresponds to the macros that we have just spoken to in the difficult economic environment, was in Kenya. I think that's how the numbers are shaping up.
With respect to Tanzania and Uganda, because to be fair, and I think this is a bit of oversight on our part, because when we speak about bank results, we often tend to have a very laser focus on Kenya. But the problem with that is it tends to gloss over some of these interesting trends in the region. So what is it that explains that decline in NPLs in Tanzania and Uganda? Is there a strong correlation between that and the sort of phenomenal growth rates we're seeing in those markets? Or is it that the credits there are simply being better managed, that companies are being a bit more proactive in how they tackle the existing NPLs they have?
So firstly, on a macro basis, Tanzania and Uganda, they performed much better than Kenya. Uganda GDP growth close to 7%, Tanzania close to 6%. But in our case specifically, what we have witnessed during 2024 is actually collections against the NPL loans we had outstanding. As I did say, out of 35, 30 is from Kenya. So the collections, like for Tanzania, that was close to about $1 billion. So shrinking that. Uganda, a similar number. So it's really collections and aggressive debt recovery efforts to bring back the money that our customers owe us.
In terms of future growth, there's a couple of interesting elements in the full year presentation that stood out to me. But one of the ones that was listed as new growth areas for the business was the public sector. And hearing that, given the sort of macroeconomic data that I tend to look at from the Kenyan state, believe in December, the amount of supply debt that they had was 530 billion Kenyan shillings. How are you going to manage that exposure, right, to state business, public sector business, where payments have obviously been a problem for quite a few years now?
Rama, indeed, this has been, I'd say, a challenge. It has come at various levels, obviously, at the national level and also at county level. But for us to use the word, it would be to be very selective. Not every government entity is necessarily a challenge to work. So we are being selective and working with the stronger parastatals that we know. We are looking at also how they connect to our various customer businesses as well. It's selective and cautious. We appreciate that the profile out there is challenging, but it is an area that we cannot ignore. Government is one of the largest borrowers that you have, whether it's from the treasury or whether it is through parastatals. And this is a similar story in other countries as well. If we look at Rwanda, if you are not dealing with government, you are really not doing business in that country. So it's selective, but we know that there is business out there that we can do.
And maybe if I can add on to that as well, is there's the asset side growth, and as Kiara says, selective, but then public sector also drives significant transactions. So if we can capture part of that transaction flow on the funding side, on the liability side, it's a focus for us.
There's a couple of questions that are coming in to us on WhatsApp and on Twitter. But before I get to those, gentlemen, I want to talk about the growth plan, right, in future, because Kenya operations now account for 71% of pre-tax earnings, at least for fiscal 24. Over the medium term, is there a target for that number to drop to as part of broader efforts to diversify the business? If we have this conversation 5 years from now, what will that PBT split among the regional entities look like?
That's always a difficult question to answer because you have to appreciate that every business wants to grow, and Kenya's leading position in terms of the contribution is not one to be easily ceded. If you look at the trajectory we've had over the last 3 years, that's risen from about 16% contribution from the subsidiaries to now 29%. Of course, there's noise in those numbers. We've had couple of those businesses were loss-making. So obviously the share that came from the other countries would be depressed and Kenya would be outside. But let me say this, it really is our expectation that our geographical diversification will be mirrored in our financial diversification. Because the reason you get out into these various countries is initially, of course, to make sure that you're able to support the customers who you are already serving and are also expanding. You're following your customers. You want to work with familiar names, but you're also tapping opportunities in those markets. The objective for each presence market we have is to become relevant. We want to be tier one in each market that we operate in. And that means that the opportunities to scale will come from organic growth, may come from inorganic opportunities that we cite in those markets. Ideally, you do not want to be too reliant on one market. And if you can get a great counterweight to your big home market, that would be fantastic. But we know that we'll keep on looking at the different opportunities, both organic and inorganic, to scale the size of our various businesses. Is there a target? If we could get to 50% contribution from all our subsidiaries within that 5-year period, that would be great. But it is an aspiration for me, at least.
There's a question that's come in with respect to loan pricing models. And for context for our listeners, this is a conversation that I believe was kicked off early in the month when your counterpart over at Stanbic, Joshua Igara, mentioned that, look, as banks, we're trying to have a conversation on having a single reference rate that would be in place to make it easier for people to just transparently price debt, price facilities across the board. Are there any updates you can give us on where those discussions are at the moment with the regulator, the Central Bank of Kenya? And assuming we do move to a single point of reference, what issues would that give you as I&M in terms of how you price your facilities?
So the discussions with the regulator, they are ongoing. We are working collectively, all the banking institutions through the KBA, we've given our input. The proposal right now is to have the reference rate based off of the CBR and the interbank rate. So there are mechanics as to how then that will work through and how to capture the differentiation in the business models of the various banks. And really, until those points are finessed and concluded, it will be, I think, a little premature to say what the impact to I&M would be. I think we'll have to see what's crystallizing. We can then work back to what that means for our counter to our current practice.
Let me add, Rama, that I think to be able to deal with this issue that's currently under discussion, we have to frame the right questions. I think the outset, when we started talking about risk-based pricing, a very important outcome that was expected was that we reflect the credit profile of our customers in the pricing that we offer. And that was the push at the time to make sure we get that. Now, we've always been at I&M about reflecting the relative riskiness that clients have in the pricing that we offer. The second aspect that is really being looked at is monetary policy transmission. Is the framework that we have strong enough to actually transmit that desired outcome when a policy decision is made? Those are the elements that we need to work on as a market and say, are we actually capturing the right questions? And then say what really then is the appropriate solution so that we can solve those two problems with a framework that we have.
Just before I get to a question related to that, on interest rates that we're getting at the moment, some of the listeners in the room at the moment will remember that we tried something similar. I think it was about a decade ago, KBR, the Kenya Bankers Reference Rate, right? Which was a combination of CBR plus, I believe it was a rolling average of the 91-day T-bill rates. And at face value, what's in discussion now seems familiar. The question, though, is what will be different this time around?
As I said, the issue is to say, how do you balance those two things? Now, one of the concerns I think we had with KBR back in the day was, yes, it is linked directly to the CBR. And as it moves, of course, that rate moves. And you've also got a linkage into some of the principal rates in the market. But you truly reflecting then the risk to capital that you have as a bank, if these rates are adjusting so dramatically. And this is a really important aspect of asset and liability management, because if you look at the sharp drop that we had in the interest rates just a few months ago, if you were to say that your primary rate is then adjusting, so all the new credit that you're putting in, even existing credit that you have on your book is repricing at that new benchmark, what happens to all of the deposits that you already have on your book that are at significantly higher prices? You have a significant repricing risk, right? So you have to balance all of these things and get outcomes that also reflect that this is actually a very competitive market. We have to trust that customers are able to switch. Nobody is bound to trade with one bank. And therefore, if you are not responsive to what the market is doing, you're going to lose out, right? And that competitive market is really what we must strive to get so that you can get that responsiveness to interest rate signals.
I want to come to a question here. This is from Jama Abdi Zed, and he's focusing on interest rates. He says we're seeing rates reducing at the moment, but for how long will that continue? And what figure do you expect it to stabilize, at least in the short term? It's been like asking you, gentlemen, to peer into a crystal ball here. We have ringside seats at the MPC meeting, but it's still going to be an interesting one to cover. Where do you think the trajectory of rates will be?
I'm more hesitant to try and predict what interest rates will be, because more often than you get it wrong. Suffice it to say that you need to be balancing at least two other macro issues, right? You have to look at inflation. We have a focus on our monetary policy on inflation targeting. And as long as that is under control, then you expect that the interest rate level that is prevailing is actually dealing with that. Now, if you're looking forward to where inflation is likely to rise, then you expect that the interest rates will respond. The other element is the exchange rate. And again, if that is stable, you then expect that that holy trinity is actually going to be in sync. So I'd say in the short term, the direction that we have seen with interest rates coming down seems to driven that equilibrium. I don't expect that we will see significant further movement downward.
But just to follow up on that, do you expect that we've essentially hit the floor with the currencies or rate cuts being where they are?
Difficult to call, as I said. I think what I'd say is as long as we're not seeing any sharp movement in any of the other indicators, then it would tell us that the interest rates level have reached an equilibrium level.
There's a question here from Gitao Kelvin, although I'm going to add in a bit of flavor to it as well. He's asking if there are any plans for the bank to get into the DRC market. We've seen that with some of the larger players, KCB, Equity Bank certainly have gone into the specific markets. But I guess with your regional diversification at the moment, you're present in Tanzania, Uganda, Rwanda, Mauritius as well. Is there really a business case to get into the DRC, or would the focus now, given the capital you have at the moment, be on growing new business lines within the markets in which you're geographically present?
I'd say that we remain open to opportunities that are in the wider Eastern Africa space. We will keep a watching brief on markets like those. If anything is interesting, we would certainly look at it. We appreciate that our customers who are particularly in the business markets bordering the DRC are doing business across those borders. It makes sense for us to then say if it is sufficient in terms of a business opportunity, we would look at it.
With respect to future growth plans, are there any specific sectors that you're interested in growing? Because I know you've spoken about, for example, the wealth management business and trying to grow that. You've spoken about bank assurance as well in a presentation here today. Are there other business lines in addition to those two that you're really keen on seeing potential growth that other players in the market haven't tapped into?
I would say that we are certainly interested in becoming a lot more relevant in segments that we haven't been traditionally strong in. And this in particular is the case in the SME, MSME space, the retail, so personal space. We are building out our customer value propositions in each of those spaces. A lot of it digital led. We've invested very heavily in the digital space. And it is being borne out in the kind of awards we've been getting, the kind of accolades we've been getting. We were recognized, for example, for being the number one bank in customer sentiment on social media, by far and away the largest, which is really testament to a lot of the investment that's happened in making sure that our customer experience on the digital front is very strong and class leading. So we expect that this provides a good platform for us to get into these new markets. We still feel that there's a lot of opportunity in the financial inclusion space. There's a lot of opportunity in providing innovative solutions in the MSME space. We have sectors in the corporate space that we are still underrepresented in. We've made a good foray into oil and gas. There's still a lot of opportunity to expand that, not just in Kenya, but across the region. We talked in the presentation earlier today about the Uganda opportunity. While they're looking to get fast oil out, it means there is a lot of opportunity in the value chain that is attached to that. We want to service that as well.
Just to be clear, that's going to be involvement in the upstream oil sector, or essentially businesses adjacent to the upstream part of the value chain. And for clarity for our listeners, when we say upstream, it's essentially the process of getting the oil out of the ground and getting that into a refinery.
Yes, exactly. And there are a lot of associated suppliers that have to work to get that oil out of the ground. So we are making sure that we are well positioned to service that. Indeed, you appreciate, Rama, that this is why the Bank of Uganda has been leading in the market, in the region, to drive capital requirements for banks. They want a strong financial sector to really enable these opportunities to be serviced. I think it's quite a wide range. We know that in the payments space as well, there is a lot of opportunity. We have built up a very nice business in the bank assurance space, very strong in Kenya. We're looking to extend that across the region. We have all done very well on the wealth management side. We're now looking at assets under management. I think it was 30 billion shillings, and that's just over a 2-year period. This is also something that we can extend across the region. So I think there's a lot of opportunity. And what we're really looking to do is build out those customer value propositions so that we can provide a range of financial solutions to the clients that we choose to serve.
Ethiopia is another one of those markets that often comes up in these conversations. Is there any interest in INM to jump into the Ethiopian market, or would you prefer much more cautious, paced approach and say, let's see how the market evolves first? Because regulations for allowing foreign entities into the market, I think, have only just been approved the other day. So what's your thinking at the moment at board level about how to approach the Ethiopian opportunity?
Ethiopia obviously is a market you can't ignore. I mean, I think it's over 90 million people that you're looking at. It's a big market. I think it is still relatively young in terms of the banking market developing, but we've been watching it for the past 5 years or so. Obviously, the discussion on opening up for banking started a while ago, but having watched it develop, there are clear expectations around deploying capital in those markets. How are you positioned in terms of owning an entity there, controlling it? Do you have the opportunity to exit if you're a minority, for example? And we know that they're building out their capital markets as we speak. They're trying to get that going. So we maintain a watching brief. I think it's an opportunity to engage via, first of all, correspondent banking and looking to support customers who are already in that place. But as I said, we'll just keep a watching brief on this until they get perhaps the structures right for bank participation.
One last question on potential M&A opportunity before I dive back into one of the questions we're getting on Twitter. With the directive at the moment, at least in this market and Uganda as well, to raise capital levels across the banking sector, do you see that as an opportunity for potential acquisitions among tier 2 and tier 3 lenders?
So the stated objective by some of the regulators who are ramping up the capital requirements is that they want to see a stronger financial sector, perhaps fewer players, but stronger players, which means that you should then see if the trigger is right, some consolidation happen. We've done a couple of acquisitions in our past, and you need to tick a number of boxes before you can say this is an attractive partner. There has to be willingness as well from the various partners. And sometimes this is going to be driven by a trigger to say, actually, this is too rich for us to keep on investing capital as shareholders. Can we look for partners? If I can only say, really, if the opportunity is right, we would certainly look at it. But it can also be time consuming to keep on tying up with different entities. You have to deal with the assimilation challenges, cultural issues. You have to deal with systems, transfers, customer impact. And so it's not that you want it to be sizable, right? If you're going to do it. But as I said, it would have to be interesting for us.
Brian Omolo has a question for you two gentlemen. Going back to something we discussed a little earlier in the hour around the value proposition on digital lending. And this is the gist of his question. He says, quote, there's a resurgence in digital lenders. They're giving loans at high interest rates and they're really giving banks, he says, a run for their money. What's the plan to ensure that I&M remains relevant in this market?
So one of the, I think, advantages of being a bank that is then providing digital lending solutions is that we have been a regulated entity for a very long time. We appreciate the direction that the regulator is going to make sure that lending is done responsibly and that customers are not suffering because of the gouging on interest rates. So we expect that the regulation of credit providers, digital lending providers, is going to drive discipline in that space. Now, from our perspective, we understand credit very well. We are looking at how we can bring in new tools to also help us understand the customer profiles, the opportunities that we are seeing from the data arising from the customers who are dealing with us. And we can therefore develop new solutions based on those insights. As I mentioned earlier, we've invested very heavily in the digital space. That includes on what we are doing around data and the insights that come from that. And I think that gives us a very strong advantage to be able to develop new solutions and scale them.
Indeed, it certainly does. I want to go back to something you mentioned a little earlier, the wealth management side of the business, because looking at the trends there, we're seeing double-digit growth, I believe, to 64% from memory, and correct me if I'm wrong, between 22-23 and then into 23-24, we're looking at a jump of around 81% in assets under management to 31 billion shillings. What's driving that growth and how do you maintain that momentum into fiscal 25?
I think all of this, it's interrelated, maybe Rama, from where we began. The clients we serve is financially savvy. As we say, the household income is under pressure. They raise that need by the client to earn a higher yield on their funds. So part of it is, as you recall, then interest rates were very rich last year. So we did see some clients pivoting out of the term deposits into wealth management. And then part of it as well is given what happened to the currency, we did see clients holding assets in foreign currency. That there was uplift in foreign currency deposits across the banking sector and for us as well too. And then when the foreign currency rates started coming down, then again, those clients looking for better return on their funds got into the wealth management. Now, in the other aspect of it, I guess, then this is more structural than anything. It's past that, and especially our young customers, maybe 20 years ago, they would have looked to start investing in land and buildings. That seems not to be the trend now. So if you're talking in terms of then stickiness and these continuing to grow, yes, we do expect it to continue growing.
Now, I want to turn our attention to challenges and strategic issues that keep you awake at night going into fiscal 25. And I'm going to list a few things that keep me awake at night from this end of the desk, looking at the macro picture in the region. And I wanted to see what your thoughts are on them, especially with respect to Kenya. I think it might be relatively difficult to call where inflation does land. Given the volatility we're seeing on some of the key inputs, oil prices might be whipping up and down. G2G might moderate some of that, but to what extent, it's a bit unclear. Food prices, ultimately dependent on how rains do turn out. And if the last 5 years anything to go by, those could push things a lot higher. Interest rates, given the fact that we might be running much higher deficits, at least on the government side, for the foreseeable future, there's going to be a lot more demand, I think, for government debt. Rates might remain relatively elevated on that side as well. And therefore, given the fact that we haven't really dealt with the disposable income problem, which in my view is the original sin that we need to deal with, speaking generally as a country, credit demand might therefore be slightly subdued. So on those three metrics, interest rates, disposable income, and inflation, gentlemen, what keeps you awake at night?
Let David get a stab.
Okay, yes, I'd say all of them, I think we are thinking about the same thing. We did on interest rates, for instance, how quickly that came down, how we had to adjust. We have to think about the reinvestment risk. We have to think about when the rates are going up, what that means to the credit quality and how quickly we adjust and recalibrate our risk appetite. So yes, however, in as much as, yes, these are headwinds, then I guess there's a sliver of hope in some of the things the government is doing on having money in circulation and paying the pending bills that knock a lot of the NPL in the banking sector, including for ourselves, to support incomes and money velocity economy. Then we are seeing the government as well, not all overly focused on bridging the deficit from the local sources. I think I saw just today, then again, 60 billion, I believe, coming from external sources. So that does give us reprieve. So it's really navigating those challenges, which I think keeping tab at it. I believe we're well equipped, but the challenges will continue to be there and they will continue to be compounded. We're talking about Kenyan economy here, but globally as well as what's happening.
Yes, I would say that you've articulated, obviously, challenges that everybody is watching. I think we have to appreciate that we're always going to see unexpected challenges. Nobody had expected, for example, that Trump 2 would have such a significant impact. And we are seeing it even in our markets and in our books because of the sudden shift in aid-related spending.
And we are barely 90 days into his first term in office.
Yep.
Another 100 plus weeks of this due to come.
This is episode 1. We have to focus, however, on what it is we can do to make sure that we can weather changes as they happen. So resilience is a really big issue for us, and it cuts across various aspects. So if you think about the impact that comes from these macro challenges, they manifest themselves in how do you actually manage net interest margins, for example. So asset and liability management is something that we're investing very heavily in to just make sure that we have the tools to really do our scenario planning very well and make sure that our targeted NIMs are actually being achieved. We're also looking at, given the heavy investments that we've made in digital and, of course, the direction of travel around the globe, of course, everybody's getting more digital. It means that you're getting a lot more challenges coming at you as a financial institution. Not only will you get attacks on your networks, you will also get very high velocity kind of attempts at fraud. So how do you build that resilience from a cybersecurity perspective? Building that resilience is really critical for us, and we have been investing continually on this space. The policy space, policy uncertainty can also be a big challenge. What we have to do is also be a voice in our various lobbying groups to make sure that the concerns that we have are actually heard and are incorporated in the policymaking space. We know all these challenges are going to come at us. The question is, how do we make sure that we are resilient enough to be able to pivot as needed?
There's a question I believe that should be the last one I'll take from the audience at the moment. This one's from Catherine Wyther. And I love these questions because they essentially encapsulate the difference between how we think about expanding the business. What's the direction of growth, the growth factor for the banking business? And this is the question that Catherine is posing. Branch expansion, she says, was huge in the last 2 years, 21 branches. So how will this brick plus mortar approach withstand the digital drive, digital lever that the bank has cemented itself on? Essentially, I believe her framing is, in a sense, if or, but the way I would look at it is maybe these two are actually complementary. You do eventually need a physical presence to backstop the digital transactions that we're seeing, even though that may eventually end up handling 80%, 90% of transactions. But I could be wrong. Gentlemen, your thoughts?
I'd say that our head of distribution recently put an article in Business Daily that addressed this particular question, because I'd say just a few short years ago, there was a huge push to just say, let's go everything digital, right? But the experience has been somewhat different. Yes, people want to be able to easily open an account. They want to be able to get service on digital platform, transact from the comfort of their homes. But you will still need physical presence, and you want it to be near you to be able to say, let me have that conversation on advice on what to do with my savings, on how to solve a particular problem that I have. So the new word that is increasingly being used is phygital experience. So you have a physical presence and you have a digital presence, and the two have to go in complement. So while currently in Kenya, about 95% of our transactions are being done on digital platforms, all of our transactions, we are still seeing that the physical presence that we have when we open a branch actually drives our brand affinity and drives customer uptake. The two have to work in complement.
Gentlemen, one last question for you to wrap up the space. And I'm going back to a data point that I actually put up at the start of our conversation. The dividend payout is around 3 shillings per share. But given all the risk issues we've discussed, and certainly around the direction of trade policy internationally, fiscal policy back home, and how that will then affect disposable income at household level, at personal level, at the direction of inflation. At one point, if I'm sitting on the board, my question would be, okay, we probably do need capital buffers. We need to hold back a bit more cash to essentially make sure that we've got enough gunpowder dry to deal with any anticipated events. But on the other side of the equation, shareholders will be saying, guys, we would like a slightly higher dividend payout ratio here. How are you navigating that tricky balance between those two?
Yes, we have to have a balance between rewarding shareholders now and supporting our business for the future and building that resiliency. That is something we considered in coming up with the dividend proposal. Just a bit of a background, policy is to target a payout of about 30%. I think we are really just about there. But in terms of then building up buffers as well as some of the business opportunities that we see ahead, I think we're well aware that in December, we did actually have a capital raise, about 5 billion coming through from an anchor shareholder. And then that together with the retained earnings on the 70% that's not paid out, we do believe it gives us the right resilience to withstand anything that may come our way in terms of a challenge and to exploit any opportunity then again that we may see out there.
All right then. Kiara, any closing thoughts, closing remarks?
Yes, thank you again, Rama, for having with an eye on Mwango Spaces. And it's great to see that 5 years on, it's still very strong and shaping the thinking that's happening in our market. So please keep it up. I'd say that we are increasingly proving our resilience in what are tough markets. We have exciting directions that we are exploring, particularly driven by digital. And it is exciting for us to see the kind of contributions coming in from our geographical footprint and from the different product lines and customer segments we're getting into. Thank you again for listening to us. And we look forward to seeing continued growth for the business and to be able to discuss this 1 year on to report what we've done since.
Much appreciation to you, of course, and the entire team at I&M. As a pointer to the sort of engagement that you have with in terms of the digital presence that the bank has. When this post on this space actually went up on LinkedIn, That had a ton of engagement in it. Normally, I don't see that sort of engagement with a lot of posts that are coming in from banks. But in this instance, I believe there was, at least on the one that I saw, over 100 interactions with it. So that does point to the strength of the brand, especially online. Kihara Maina, Regional CEO, I&M Group, and David Ngata, Group CFO, also at I&M. Thank you very much for your time this evening. And of course, much credit to Eric and the team behind Wango Capital. They've managed to grow this brand progressively over the last 4 or 5 years, and hopefully they'll still be here for another 4 or 5 years to come. And of course, to you, our audience, having dedicated the last hour of your time to listen to us talking about the performance of I&M in the last 12 months and the future direction of the business. We know you could be doing something else on a Wednesday evening, so we do not take your time and attention for granted. Thank you very much, and we'll see you in the future in more Wango spaces.